Josh, you're using a 7% rate of return for future investment prognostication. Oh, that's crazy. I don't think so. I get this observation quite a bit actually, but I don't think you're going to get 7 or even 8% a year return, and I actually disagree with that explicitly. And the reason is simple, because investment returns, you look at two things and two things only. You look at earnings growth year over year, and you look at dividend yield. You can look at a price appreciation or capital appreciation or capital depreciation, and that would say, hey, if the PE ratios are high, you would not expect price appreciation. You'd actually expect price depreciation to reduce some of the gross returns. And I don't have any qualm with that. So I'm using about 2% dividends, 4.5 to 5% earnings growth year over year. And if you look at the big three and investment, in my opinion, is the Titans, one of which just passed last year, which is Jack Bogle from Vanguard. Over the next 10 years, they're all saying anywhere between 7 and 8, and on average about 7.5. And again, that's gross before inflation kicks in. And so I'm actually on the lower end of them. And Siegel is saying about 7.5. I think Bogle is saying, I think 7, and Schiller, I can't remember, but roughly 7.5 across the board. And I'm using an 80-20 portfolio, diversified heavily internationally, domestically, with a little bit of exposure to bonds at 7.1. And I'm using that for not just the next 10, not just the next 20, but for the next until you die. So in this case, in Karen's case, that's 30 years. I'm saying for 30 years, she'll average 7.1% with a standard deviation of 15.5, I think is what I had. So we have a pretty significant high standard deviation, historically right on with the S&P 500, and yet a much lower historical return than the S&P 500 as well. So when we're looking at Monte Carlo analysis, we're looking at standard deviation, and we're looking at average expected rate of return, which is 7.1, and so it's going to be all over the place. So we're using a similar risk profile than the S&P 500 historically in terms of volatility, and on top of that, we're using a much lower rate of return because we're using a gross return of 7.1. And again, it's based on two things and two things only: dividends and year-over-year earnings growth. Now, the third part of this equation is price appreciation or price depreciation, and we say that's PE ratios. How much dollars are you willing to pay for $1 of earnings? And historically, the higher the PE ratio at the beginning of your time, the year or the decade or whatever, the lower the future returns. The lower the PE ratios, the higher your future returns. It only makes sense. In 1999, you had a PE of what, 29, 30. I mean, there's no way you're going to get a price appreciation with a PE of 29 or 30. Just not, especially back then when the 10-year treasury is like 4 or 5, something like that. It's just not going to happen. And it proved out. So no, we didn't get what historically we got. And the reason for that is because we had the price depreciation as price to earnings ratios went down, everything reversed to the mean. All right, so right now we have a trailing, the forward 12-month PE ratio, I think is 19.4. So we're saying based on forward projected earnings, our PE ratio is 19.4. Historically, it's 15.5. So we're basically 23, I think I did yesterday, a couple days ago, 25% higher on price to earnings projections over the next 10 years than historical averages. Does that make sense? So we have 19.4, historically it's 15.5, so we take 19.4 minus 15.5, we'll just say 4, divide that into 15.5, and that means it's a 25 or something like that, higher potential PE ratio than historical. So we are trading at 25% higher relative price to earnings. And that's where everyone's saying the market is too frothy, the PE ratio is too high. Of course, what they always forget is that the 10-year treasury is at 2.39, all right? And historically, the 10-year treasury is at 5.5. So when you look at the yields of the 10-year treasury and you say 2.39 versus 5.5, that means the price of the 10-year treasury is over 100% higher than historical averages. So if the stock market is 25% than historical averages, well, what's the alternative? The alternative is the bond market, which is over 100% higher than alternative averages in terms of the prices that you pay to buy the bond. And again, that's just because the yields are so low. And so, I mean, it's one thing to say the PE ratio of the S&P 500 is significantly higher if we had a 10-year treasury paying 5.5. We don't have anywhere near that, my friends. The 10-year treasury is at 2.39. So you always have to look, where does money want to go? It wants to go where it's treated the best. So everything is pricey: real estate, bonds, and stocks. So the only thing that would say, if I'm an investor and I can invest in real estate, bonds, or stocks, I'm like, okay, what do I have? I have stocks that are trading at 19.4, 25% higher than historical averages. Bonds that are trading at 2.39, which is over 100% higher than historical averages. Real estate is pretty high too. In fact, that's why it's a tough time to be in the renter market, just because the demand for housing is through the roof. Just we're not building enough houses relative to, we're just not. And so because of that, homes are expensive. And then if you go to some of these more urban liberal areas, the homes are incredibly expensive because they're putting growth limits on production. That's just a fact. So all three of these things, rentals or real estate, stocks and bonds are heavily higher than historically. So what do? I mean, you could go to CDs, and I guess you could say, I pray for war or something like that and hope there's deflation, because CDs, if you're in a deflationary area, would do wonderful. I don't expect that. In fact, I actually expect that given the number of cash that the companies have on the side, given the fact that they're only paying out, I think it's 35% of their profits in dividends, lots of cash on the side to reinvest in either increasing dividend yields when the stock goes down to keep it above water, or they could buy back shares as well. So tons and tons and tons of cash on the side. Man, on top of that, I just did a video today that America is back to #1 in overall world competitiveness by the World Economic Forum. So we've been puddling along 3 to 5, and now we're back up to #1. So the U.S. Is just booming in terms of the potential for earnings growth year over year relative to saying we're only going to get 7.1. So look, I'm not here to be a Pollyanna. I'm not whistling past the graveyard. If you think the stock market doesn't have any opportunity to give you 7 to 8% a year, well, where are you going to put your money? I mean, a 10-year bond's 2.3, man. And look, the stock market isn't this vast gambling. It's where you go every day. It's Costco. It's Walmart. None of these places are a lack of clients. It's wherever you go every single day to buy your Starbucks. I mean, to buy your food, buy your groceries, buy your stuff that you live on. I mean, it's KB Homes, it's Ruger. I mean, these things aren't. It's ExxonMobil. I mean, these things are not hurting financially. I mean, some are. That's the nature of the stock market. Some are hurting. They're doomed because they did bad things with cash. Sometimes it's just bad luck. But the idea that the market is so highly valued that we can't expect 7 to 8% a year, I frankly don't believe that at all. I think I'm underserving it. And don't forget, I'm also saying Social Security cost of living adjustments are only going to be 2.6, and yet inflation is going to be 3. So you're inherently you're losing every single year to inflation at 3%. Inflation is not anywhere near 3 right now. It's just not. So we're saying stock market is on the conservative side, an 80-20 portfolio, give it about 7.1. We're saying inflation's at 3, so your net return after inflation is 4.1, man. That's just not significant. That's not significantly optimistic, let's just put it that way. Again, I'm erring on caution because I think that's the way to go. And then, of course, we're saying your healthcare expenses are growing at 5% a year. And I don't know about that. That seems fine to me, but I don't know. 7% on stocks, gross, I got no problem with that in the least. So that's my argument. Buffett said just the other day, I did a video on him just the other day when he was being interviewed by the lady from CNBC, Becky. He said if bonds stay where they are in interest rates, the stock market is way undervalued. This is Warren Buffett, not me saying it. Buffett saying the market is way undervalued if the bond market stays where the rates are as they are now. And the reason for that is, again, because the bond market is 100% higher today than it was historically. Where stocks are not 100% higher today than it was historically, they are 25% higher. So you always got to look, what's the opportunity cost? I have to make a decision. Do I go there or do I go there? And for me, it's not debatable. I'm not touching the bonds with a 10-foot pole because I'm not getting any bang for my buck, and I still have all the risk of inflation of taxes, or at least stocks, while they're higher price than historically, the alternative investments aren't very alluring at all. All right, hope this helps. We'll see you.